Okay, Jax, we live? We are on, Jackie, you can start. Welcome to today's 12J webinar on 12J investment opportunities. I'm Jackie Cameron for BizNews, and with me today we've got Pearl Valley Hotel by Mantis Executive Chairman Adrian Gardner, and we also have Futureneers Capital's entrepreneur Dion Lewis. So we're going to be chatting about a very, very exciting investment opportunity in the Western Cape, which has been the brainchild of Adrian Gardner. As many will know, Adrian is one of South Africa's top hoteliers, and in fact not only South Africa's top hotelier, but he's expanding into Africa with some really exciting hospitality opportunities, which he's going to tell us more about shortly. Dion Lewis is an entrepreneur, and he's been behind the scenes working on how to generate good returns from this investment. So he's also going to be weighing in and giving you insights into how this particular 12J investment opportunity can help you grow your investment returns in the short term, but also over the longer term. So let's get started with Mr. Gardner. Very warm welcome to our webinar. Can you please, briefly, before we get into the meat of this 12J investment opportunity, can you tell us about the Mantis collection and the Accor group and how you got to be involved in this particular project in Pearl Valley?
Thank you for the invite, Jackie, and morning, Dion, and thank you for all your help with 12J. Just to give you a little bit of background about Mantis, it started with the creation of Shamwari Game Reserve in the Eastern Cape, which you'll recall was, a lot of people laughed at me when we started that journey. But I think the legacy today is that the Eastern Cape is now a wildlife destination. So a lot of the farmers have converted their properties into wildlife reserves. And then that was in 1992 when we opened there. By the year 2000, I had like 5 properties in our portfolio, which were quite amazing properties. For example, we opened the Saxon Hotel, we had Steenberg Wine Estate, we had a property on the Garden Route, we had a property in Port Alfred, and obviously I was looking for a brand. And so a lot of the other international brands contacted us, and I thought, no, I wanted to build our own brand. So I was very fortunate because besides being a fair plagiarist, in other words, seeing what other people have done before me, try and do it a bit better, is that I'm a great believer that you need endorsements if you're doing something new. So with regard to Shamwari, I was very fortunate to be able to meet Dr. Ian Player, who I think most of us realize and know was responsible for saving the white rhino from extinction. And, you know, he came and saw my vision for what I was doing at Shamwari. And that was in 1992, just when we opened, and we became exceptionally good friends. And I then joined his foundation and then eventually became chairman, and today I'm patron of the Wilderness Foundation. But he was staying with me in the year 2002, and I came to him that night and I said to him at dinner, please help me with a name, because all my staff have come up with the normal things, a gold, platinum collection and everything. I need a name for our collection. And he came to breakfast the next morning and he said, you achieved 2 things. You kept me awake all night, but I've got your name. And I can tell you is that and he really thought about it deeply, and the people that had influenced him. And he had a guard called Mkubu Ntumbela, and then he was very fond of a guy called Sir Lawrence van der Post, and who had a big fascination with the Bushmen. So he thought about that, and then he thought about what really was the Bushmen's, call it their follower or whatever. And they were transient people, and they went all over. But wherever they went, there was a praying mantis looking over them. And he said, your properties are small, and you allow the general managers to get involved and look after them. So I would call it the Mantis collection, and hence you see all our profiles and everything. We have what we would call a mantis that's a little bit doctored to look a bit more, I would say, modern in today's society. So then we developed this Mantis collection, and we created the acronym, Man and Nature Together is Sustainable. So Mantis has been developed over because the start of Shamwari, we put back the big five there. So we have our own big five in terms of our ethos, and that is we start with development. For example, when we developed the hotel at Pearl Valley, that was a development. So we take control of the development and we appoint all the people and the subcontractors and everything. Then we have what we call our hospitality division, because it's got to be run by somebody. Then we got to fill the beds. So we have our marketing division. And then the two other principles which are ingrained in us is our education philosophy, because we started the university in Port Alfred called Stendon, which is the only university in Southern Africa where you can do a BCom degree in hotel management and hospitality. And then the other important thing is conservation. So we then started the fund, the CCFA, the Community Conservation Fund Africa. Now, this all happened and carried on, and then we found by the year, we had about 80 products with our brand on around the world. And we were the only brand in the world on all 7 continents, because we had an Antarctica experience. Then what happened is that we found that, you know, it wasn't working in terms of, we didn't have the right booking system, distribution system, loyalty program, and whatever. And then the opportunity came to be able, and Accor came to us and said to us, would we be interested in selling a percentage of our management company to them? And I said, that's exactly what we're looking for, but it's really based on 3 things. The first thing being is that we need a distribution system. The second thing, we need a loyalty program. And the third thing, we want to create a conservation fund, and hence we came up with the CCFA. So that's why we did the deal with Accor, and I must tell you that it's been a great journey so far. It's almost 3 years old, and they bought 50%, as I said, of our management company. We still own all the properties. They did invest in one of our properties, which are the boats on the Chobe Zambezi, and the reason for that being is that, you know, it's a complicated situation that we have there with leases with headmen and things like that. So, but otherwise, it's achieved what we wanted to achieve. We've achieved a loyalty program and we've achieved a distribution system. And with that loyalty program, we're trying to get, and they've converted everything and they've virtually got it adapted, whereby we can go to people to say, instead of burning their points and staying with the hotel, they can burn the points to stay in the hotel, but they can also burn their points towards our conservation fund, where we can really make a difference to the communities next to us, to the impact we're having on them, and that sort of thing. So it's been a great journey, and you know, it's really the beginning. But the Mantis property at Pearl Valley, which I think I'll go into just now once you get to the next question. But I think does that give you the background that you're looking for, Jackie, about Mantis?
It does. One question I wanted to ask you, I was really struck in your branding. You talk about one of your underlying philosophies is that you actually are storytellers. You're not just hoteliers, you are storytellers, and you want your guests to leave telling great stories. I thought that was a very interesting angle on hospitality. How do you feed that into the Pearl Valley experience?
Well, I think that, you know, the story with the Pearl Valley experience is quite interesting, because obviously we then are talking about what can we do there. There's golf there, and there's our association, because as you know, that in the whole estate, our partners are Val de Vie and all the things that they do there. In other words, they have they've got the wine estate with all the people that are involved there. You can do a marathon there. You can do all those sorts of things there. So it's quite different. And, you know, our experience with golf has been, fortunately, quite significant in that, as you know, in the early days, we did own Steenberg. We are custodians of Fish River. And at the moment, we also have the rights to build a similar product on the links in St. Francis. And we are building a similar product at Zimbiti. So, you know, the story that we tell there is not only the story about where we came from, what we do, but it's a story about, if you come to any of these properties, there's more than just a hotel. There's so much to do. There's so much to experience there. And we try and instill this on all the people that work for us and show them that there's something more than just staying in our hotels.
Just tell us a little bit more about how you chose this particular area and this opportunity of all the other potential opportunities in the Western Cape.
Again, a very interesting question, and thank you for that, because in 2007, I sold 70% of Shamwari Game Reserve to Dubai World. And as you know, Dubai World also then bought Pearl Valley. And then 2008 came, and you know what happened to the world economy in 2008, and Dubai World decided that they were going to exit a lot of their assets in South Africa. And I then exited out of my 30% at Shamwari, but I managed to keep my lodge, the Founders Lodge, where it all began, right next door to Shamwari, with full traversing rights and everything there. And then I think, as we all know, is Dubai World then put Pearl Valley into business rescue, because they get it with a bank considerably, and they decided that there was no easy exit strategy, so they put it into business rescue, and then the bank owned it. So, and I, as part of the settlement to get out of my 30%, Dubai World gave me the only asset that wasn't geared to the bank was the director's house on Pearl Valley. So I had a bit of an interest there, and then the bank that I knew well, the people there phoned me and said to me, look, we have this hotel, right? We're obviously the developers now. We want to develop the hotel on the site. So we then were busy with that, going down the road, and then all of a sudden the bank got hold of me and said, look, we have an instruction. We have to exit this asset. So I said, okay, fine. And I've got a partner involved, and we decided that we would buy the asset. And then the next thing that happened, they came back to me and said, look, we've also had discussions with Valdivia. So, we're in a bit of a situation here. So I said, that's not a problem, because I know Martin Fenter very well, who was the developer and a majority shareholder of Valdivia at the time. And so Valdivia and ourselves put a deal together whereby we purchased the asset from the bank. So I had the asset there with a hotel site, which we still owned as Mantis with our partner. And we decided, well, here's a good opportunity, because we did quite a lot of research. They had an incredible conference center within the clubhouse there. So here we were building a hotel with rooms, and look what we had already on our plate. We had the clubhouse, we had food and beverage, we had a spa, we had the conference center, we had a golf course, and we just had to put up the rooms. So, it was an opportunity, I think, made in heaven. So that's really how the background started. And then once we did it, then we got the inquiries from obviously the links, and then again from Zimbiti, because they thought that we knew what we were doing as far as developing a hotel with surrounding assets.
Thank you for that. I see some questions are coming through now, and we're going to discuss more of the lifestyle issues shortly. But for the attendees, please feel free to put your questions in, and we'll get to those questions as soon as possible. What we'll do now is we will just hear from Dion about some of the more technical details of this investment. Dion, can you see your slides?
I can see them. Thank you, Jackie, and thanks for inviting me. Hello, Adrian.
So Dion, perhaps you could just briefly, the first question is, what is the minimum investment allowance allowed? But perhaps we could just take us through your track record first.
Okay, so as viewers can see on the screen there, we currently have just under 300 million under management in various assets, most of that into various property assets, including Pearl Valley. Important that this is the third round, or the third tax year that we're now raising capital for Pearl Valley Hotel by Mantis. A strong product pipeline or underlying project pipeline, 120 investors that has invested through our fund over the past 3 years, 23 underlying qualifying companies that has been invested into, and we've issued close to 200 12J certificates to date. And I think the partnership with Mantis for us is a very important one. We've worked very well with them, and it's been a very good relationship for both parties to date.
Thank you. And then the people behind the investment are always very important, because the devil's in the detail here, and you've all got, you all seem to have a lot of credentials in the chartered accounting environment. Dion, can you just briefly sketch out who you will be entrusting your money to when you invest in this 12J opportunity?
Yes, so the executive team, you'll notice on the left-hand side there, is made up out of myself, gentleman called Jaco Gerber and Dirk van Dochenberg. We're all ex-PwC. And on the right-hand side, we've got a very strong advisory board. Renier Swart, also a shareholder in Valdivia, as well as the CEO of Valdivia Construction. On our advisory board, Stefan van Niekerk, that transfer attorney that does most of the transfers on the Val de Vie and Pearl Valley estate from Ministers attorneys. He's on our advisory board. And then Neil Hobbs. Neil is a competitor of ours and arguably the leading scholar on 12J in South Africa. Neil formed the very first 12J, back in, I think, 2010 on our advisory panel. And then Johannes Boysen, entrepreneur, a gentleman that we've been associated with for many, many years.
And a lot of people attending this webinar obviously know what a Section 12J is, but just briefly, perhaps you could just briefly recap the tax benefit and what the rationale is for the Section 12J, which unfortunately is coming to an end at the end of June.
Sadly so. So maybe just quickly on the deduction. So let's take R1 million as an investment example. If you're on a 45% marginal tax rate, it means that you can deduct R1 million off your taxable income for that particular year and only pay tax on the balance. Now, if you relate that back to a property investment, it effectively means that you're discounting your property investment by up to 45%. There's limits, 2.5 million for an individual, 2.5 million for a trust, and 5 million for a company. And I want to focus on the right-hand side of that screen as to the structure that investors would be investing into. For a moment, if we can just remove that Futureness Capital black block there in the middle, normally if you would invest into property and the ownership would sit in a company, it would be the investor at the top taking up shares in this case, let's call it the hotelco, and the hotelco will then buy various hotel rooms, and the investor will be a shareholder. So what we're doing from a 12J perspective is we call it wrapping the opportunity in a 12J wrapper. The investor takes up shares in a specific class in Futureness Capital. That class is linked to the economic rights of only the hotelco company, which is the qualifying company at the bottom, that owns and acquires these hotel rooms from the developer. So the investor has a share ultimately in that hotelco company. If dividends are declared, dividends declared back to Futureness Capital, no dividend tax, and then from Futureness Capital back to the investor, and there will be dividend withholding tax applicable. That's the structure.
So they own a stake of Futureness Capital.
They own a stake in Futureness Capital, and Futureness Capital in that class of share owns the underlying company. And also important, investors that are interested to look at this opportunity, we will make the MOI available of Futureness Capital, because the concern is always, what happens if something goes wrong in one of the underlying investments in Futureness Capital. And we'll notice in the MOI that as directors, we can't gear in Futureness Capital, we can't sign surety, so it's a silo investment holding structure. So there's no risk for investors between classes of shares.
So a lot of questions that have come through are on the personal use benefits. So perhaps you could just briefly take us through that, Dion, and perhaps we can get more detail from Adrian.
Okay. So you'll notice that for a cash investment, let's just focus on that for a moment. For every $1 million that you invest, you will receive 10 nights free usage of the hotel. Now, if I say free, I mean there's no rate to be payable except for the cleaning fee, which is 200 Rand per person, and then breakfast. Depending on the funding mechanism that you would use, that we'll get to a little bit later in this presentation, the days change, and the free nights change a little bit. You'll notice that if you use the smart loan, for every $1 million you get 6, and if you use the bridge loan, for every $1 million invested you get 8 room nights. Furthermore, 50% discount on all nights if you've used up your allotted 10 or 6 or 8, whatever it is that you get depending on your funding mechanism. If you then want to use the hotel over and above that, and then 20% discount off the rack rates or prevailing rates at any one of the other Mantis Sub-Saharan African assets. And there's golf membership included. In fact, it still says optional discounted golf membership. We've just yesterday confirmed that it's actually full membership, and investors will only pay membership green fees when they use the golf course. It'll only be for the investor. So if there's 2 people, if there's an investor and a partner, it will be for one of those. And the other one will then pay visitors rates. and then yeah, the use of a golf cart while in residence.
Adrian, you were telling us a bit earlier about some of these other Mantis managed hotels in sub-Saharan Africa. Can you just elaborate a little bit here? The one where you go to Rwanda, for example, is really sounds like a very exciting opportunity.
We've had amazing experience in Rwanda. You know, unfortunately with Dubai World, I went there about 12 years ago, and we wrote the master plan for rehabilitating the Akagera Wildlife Park. And subsequent to that, African parks have done that. But we manage the hotel on that park. We also manage 2 other government hotels. So we operate a hotel in the south, in the east, and the west, and we've just signed a contract to manage a property next to the gorillas. And we have a signed contract, and we are launching a boat equivalent to the Zambezi Queen, which I'll tell you about just now, as our portfolio. So we'll have a houseboat on Lake Kivu. So Mantis currently is the biggest operator in terms of number of hotels in Rwanda, and 3 of them are government properties. We've just done a massive development plan for a precinct within the middle of the city of Kigali, and they were most impressed with that as well. So we have a great footprint there, and for anybody that hasn't been there, I must tell you, it's inspirational to go to that country, to see what they've done there, to see what they've achieved there. You know, I get the negative comments now and again to say, well, there are only 12 million people there. Well, I've said to our Premier in the Eastern Cape here, well, only 8 million people here. So let's set the example in the Eastern Cape. You know, for example, there is 0 litter in that country because the president closes a country for 2 hours every month on a Saturday, on the last Saturday of the month. He personally is involved, so you see no litter. You arrive at the airport with a plastic bag, it's taken away from you. Every person that has a property or a piece of land in that country has a title deed. So there's a hell of a lot we could learn from there. And we've been very privileged to be able to grow our brand there and get the support that we do from the government there.
Adrian, before we ask Dion to move on to his next slide, we've got a couple of questions about the lifestyle benefits. And the one question is from Dennis. He wants to know, can a family member or friend use my personal benefits if I can't?
Yeah, there's no problem with that. So you can come and book, provided that the booking is done directly with us. We would offer that 20% discount, obviously on the basis that it is referred to us by the owner. And I just want to tell you is that, you know, just as Rwanda, as you know, is known for the gorillas, but I think we're also known for our boat collection on the Zambezi Chobe. You know, we have 4 boats there, houseboats, and a lodge there. And that's probably one of our most popular destinations in Africa. Plus the fact that we have properties now in Tanzania, and we've just been awarded a big contract in Kenya, and we have a property in Zanzibar, and obviously we have all those properties that we have in the Eastern Cape. So, you know, if somebody did, and Dion, I just really hope that you managed to sell the last lot of rooms there, because we consider your investors to be ambassadors of ours, to go out there, to use our properties, to acknowledge our property, to see what we do in the conservation and education world and in the community world. So, you know, every one of those people that come in and buy a room, we consider them to be a partner of ours, not just an investor, but an ambassador as well.
Kobus has a question about the lifestyle benefits as well. He says that he thought he heard Adrian Gardner mentioning in an interview earlier that there was 30-night free use of rooms, but this slide suggests maximum 10 rooms. Could you clarify?
No, well, I did mention that in the podcast I did yesterday, and that I think were related to the first phase, Dion. And remember that 30 nights was if you had one investor for the one room. Now you're talking like R1 million. So you were obviously talking, so per room, there's still, I think you said 26 nights, but I'll leave it to you to explain.
Yeah.
Okay, Dion, do you want to pick up on that?
Sure, thank you. If I could just clarify that. So if an investor, and what Adrian was trying to say in his podcast, is if an investor would buy a room outright and sit with a title deed, he would get 30 nights. But remember, this is a fractional investment model that we're selling here. And there's a fee component. So if an investor invests R1 million, there's a fee component that gets deducted, and the balance of the money is going into the asset. So we obviously have to adjust the number of nights proportionately to the investment that's going into, you know, into the underlying asset.
Hope that answers your question adequately, Kobus. Dion, should we crack on with the next slide?
Sure.
the targeted return.
Okay. So this is the breakdown if you analyze the cash investment internal rate of return and how we get to the 20.3% pre-tax IRR. So I've broken it down to different elements so you can see what the building blocks are. So you'll notice at the bottom there, it starts off with a negative of 1.8. Now those are costs. So it's the 12J annual costs. It is the pro rata rates and taxes element. And there's also one must to remember, if we go back to that structure of what the investment structure looks like, the investor ultimately takes up a share in a company. So there's company tax to be paid. And if we get to the return, the 6% guaranteed return that we've negotiated with Mantis, investors must remember that 6% guaranteed return is paid from the hotel operator into the PropCo company taxes deducted, expenses, and then the balance is then distributed through dividends. The rest of the breakdown of the IRR calculation, then if we move upwards on those blocks on the right hand side, you'll notice that there's a 3% contribution, which is then the 10%, the 10 room nights per million. Then there's a 6% gross yield from hotel operations. Important here that we've negotiated with Mantis as a COVID hedge, 6% for year 1 and 6% for year 2. And hopefully by that time, we will outride COVID and the hotel will produce, between 6 and 10% gross yields. Then we've worked on a 5% capital growth. Sorry, Jackie.
No, please continue. Sorry.
We've worked on a 5% projected capital growth of the underlying asset. And I think important that listeners understand here is that if you look at the actual numbers of those assets sold 4 years ago and what they're selling for now, the real capital growth, albeit off a low base, was 20% a year, actually 19% a year. So I think 5% projected capital growth on the underlying asset is a fairly safe assumption, and hopefully it will do much better than that. And then the 8.1% in the black block there then is obviously the 12J contribution, assuming that the investor is on a 45% marginal tax rate. So one can see what the massive impact 12J has. And just to put that into context for investors, assuming that this hotel delivers zero yield and there's zero capital growth, which in both cases is unlikely, just your 12J return, on a 45% marginal tax rate contributes 8.1% of your IRR. So hopefully that clarifies it, and if there's any questions, please shoot.
Adrian, perhaps you could just recap for us a bit about how that investment has been doing over the past 3 to 4 years. You mentioned to us earlier that these returns were quite spectacular, actually.
Yeah, the return in terms of capital growth was certainly pretty spectacular in that, the average sale that we did in the first phase was 1.3 million. And today that's selling at 2.3, 2.4 million for the room. So, I mean, you can see there's a million growth over that 4 years. And that's, I think, how Dion got to the 19%. But obviously with COVID, the issue with regard to a return in terms of room nights and that sort of thing has been very difficult. But, in terms of the rental pool agreement that you have, and I think it's pretty important that the investors know, is that, you've got a sectional title unit there, which normally would attract levies and everything. We as an operator pick up those costs. So you're not involved in those costs. You're not involved in any of the maintenance of the incredible garden areas, the swimming pool, or anything else that's there. Plus the fact that we have an incredible boutique brand there called Bax as our restaurant in Delhi, which is obviously owned by Fairview, and is become so popular that, I think it's important, Dion, that your investors also know that in every room there's a kitchenette, so there's a little stove and all the rest of it. So you can go down to the deli, you can get what you want, you go upstairs, warm it up, and you can eat on their beautiful veranda with the views and everything like that. So it's not just a hotel room operation. It's when you're there, it's like your home. So I just think it's very special.
Adrian, Francis has a question for you on that topic. She says, what are the occupancy rates? And perhaps you can elaborate. Now would be a good time to perhaps share your thoughts on how you factored the COVID-19 pandemic into your plans.
You know, the occupancies at the moment are horrendous. I mean, we've been quite practical. So we're looking to see if this year, if we could achieve a 30% occupancy, I think we would be doing well. And I've just been listening to a seminar which was worldwide now, with a lot of people on it, and about COVID and the vaccines and everything. So to increase the occupancy in the short term, I think I would be guessing, you know, and I've been in the game a long time, and it's pretty sad that we can't give you that. But what we've had there to help our occupancies, and I must say that it's attracted some quite interesting tenants. So what happens is that we're allowed to do what we call an extended stay. The extended stay is only for 28 days. We can't go further than that because it has a VAT implication. But we have people that will extend their stay and extend it further. So you can come and book out a room, and people who are doing alterations on their homes or waiting for their homes to be transferred are coming to us and taking an extended stay, which has helped our occupancy. The rate isn't great, but we've done our sums on it, and it's working. So at the moment, in terms of the rooms that we've got, I think we've probably got 15 rooms that are on extended stay. So that's one of the plans that we have to try and increase our occupancy. And obviously, in the hotel business, it's not all about occupancy. The other 50% of the equation is about achieved rate. So that's one of the most important things to get. And, you know, people say, well, you know, the South Africans are dying to get out there and enjoy space and everything else. That's quite right. But a lot of our properties are built around an international standard, whereby we did depend at least 50 to 60% of our occupancy being from international travelers, which, as we know, and if we are practical, the short term of that is not going to happen. So that's why I think Dion came to us and said, look, to give the people some comfort, let's give them the 6% guaranteed return. Now, that is a guaranteed return because, again, between Futureneers and ourselves, we've arranged with Investec Bank to underwrite that guarantee. So we've taken a portion of our development profit and put it in with Investec, that they know that on that date that it's due, and I think, Dion, you pay it quarterly, is that the return will be paid. So you've got no fear on that. Whereas within the first phase, we had obviously the difficulties with COVID and a few other issues, but we've almost covered all the guarantees that we gave on phase one. But phase two is definitely a different thing because it's been guaranteed by Investec Bank.
If I could just add to that, Jackie, just one correction, that the annual dividend is paid in March, so it's annually, it's not quarterly. So just an important thing.
Oh, sorry. Yeah, I wasn't sure what you'd arranged there, but it's guaranteed.
One question that comes up quite often in our 12J webinars is an issue that's been raised by Hermarie. She says that given the uncertainty about property rights in South Africa, why is this property a good investment? So perhaps you can just share your thoughts here on whether you think that this investment might be at risk from the land expropriation bill that is on the table in Parliament. Adrian, would you like to take that question? Obviously, this affects all of your properties.
Yeah, I think it's a very important question, but I would think that certainly when you take Val de Vie and Pearl Valley, I mean, there's no doubt that there were never any land claims there or anything like that. So, and I mean, it's an enclosed estate, it's pretty secure and all the rest of it. I don't think that it's really going to affect estates like that. Obviously, our concern comes where you have game reserves and wildlife parks and that sort of thing. I think we all, obviously, it's a good question, concerned about where that bill will go to, and obviously there is quite a lot of opposition about it. But I think we've got to be practical in South Africa, and maybe we should take a leaf out of the Rwanda book and start giving people title deeds. And I know it's not easy when you've got homelands with, you know, big areas of land controlled by chieftains and that sort of thing. But, you know, I have sympathy for a lot of the people in South Africa who have been living on land for a long time and don't have the asset. And we've tried to address that in some of our properties. And it's a very interesting question. Obviously, we can't underwrite it, but I would be very surprised if you invested in an asset such as a sectional title hotel room on an estate like Pearl Valley or Val de Vie, that you would be at any risk regarding that. I don't know, Dion, whether that makes sense.
Thank you, Jackie. I agree fully with you, Adrian. You know, the important for investors to understand that this asset is located, as you explained earlier, on the estate. So I don't think there's a risk as far as that's concerned.
Kobus has a follow-up question to Hermary's question. He says he thinks we own a room through the title deed of that room. Adrian mentioned the room number would be on the title deed, but does Dion suggest it's a fractional share? So perhaps further clarification around the actual ownership details, please. Dion, would you like to pick up that question?
Yes. Yeah, I think one has to differentiate between a cash investment or an investment rather that you invest into the room and sit with a title deed in your hand, which is a normal property transaction. It's a sectional title unit that you acquire, you sit with a title deed. What you do here is you invest into a company that would use your capital to buy various hotel rooms. But depending on the value of your investment, taking into account that a room costs between 2.3 and 2.4 million rand, if you invest 1 million, you would own theoretically a portion of a room. But in reality, you own a share in a company that owns multiple rooms, and you would share in the proceeds of whatever those rooms produce in terms of the agreement between the PropCo company and Mantis as the hotel operator. I don't know if that explains it.
I think that's pretty clear. Kobus, if you have any further questions, just pop those into the question box. Dion, quite a few of the questions that are coming up now, I think you're going to be dealing with in your presentation. So perhaps we can just move on here to the funding models, which a number of people have asked about.
Sure.
Can you help them with money?
We certainly can. And again, you know, as entrepreneurs, we listen to our investor base, we listen to the market, and we've adapted these funding mechanisms over time. Every year we learn a little bit. The first and obvious one is a cash investment. It's 100% cash upfront for whatever you want to invest. Then the second one is a bridge loan, where you pay 55% cash upfront, and then we bridge 45% of the investment for you over a period of time, depending if you're a provisional taxpayer or a PAYE payer. That period can differ between 3 months to 14 months. There's an interest component, of course, in there, and we'll get to the detail of that now in the follow-up slides. The third one is a smart loan, which is an installment loan, which I'll explain. And then the fourth one is what we refer to as global hedged one, where we give investors the opportunity to either use their cash that they have offshore to gear against to make this investment, or help them to take money offshore and then gear against that to make this investment. So Jackie, if you can just move on to the next slide for me, I can explain the bridge loan.
Can you see the slide?
Thank you, I can. So yes, as I said, 55%, assuming that you invest R1 million upfront in cash. We bridge the 45%, which is in this case 450,000 rand. Your funding cost over a 14-month period, assuming that you're a PAYE taxpayer, and the reason it's 14 months is because you'll do your tax assessment next July, and you'll probably get your money back from SARS next August. So your total cost of funding over that period is 35,000 rand. We're working on an interest rate of prime plus 2.5. And then when your SARS rebate comes back, you effectively settle that 45% plus then your interest component. Just move on to the next one for me, Jackie, please. The smart loan. So what we did here was we tried to simulate an installment loan or a bond. So the monthly, assuming that you invest R1 million, you will require 5% cash upfront, so 50,000 rand in this case, interest rate of prime plus 2.5%. The monthly premium is calculated over a 20-year period. So you'll notice on R1 million, it's 9,500 rand a month, although you actually settle this entire loan in 5 years. And the way that you get that right is your rebate from SARS, because remember now, you've put down 5% cash, we've lent you 950. So you're still making R1 million 12-day investment. So therefore your deduction will be on R1 million. You're going to get 450,000 Rand back from SARS. In terms of your loan agreement, you're obligated to offset or to make a balloon payment against your loan of that 450, which puts you, if you look at this graph, at around about 50% LTV after, let's say, 14 months. And then we also take the hotel dividends, so your proceeds of your investment, as long as the loan is outstanding, we offset that against the loan for you. So in under 5 years, you've effectively settled this loan with zero debt. You can now continue to enjoy the investment benefits, including all the lifestyle benefits. But important here is that while you're paying off this loan, you obviously can also enjoy the lifestyle benefits as discussed in the earlier slides. Just from an interest comparison perspective, if you look at that square block in the bottom, sorry, one back, thank you. Over a 20-year period, if you bonded this, let's assume you would have paid 1.1 million Rand in interest. On this particular loan, your total interest is 168. So that puts it in perspective for you. And then the last one, which is referred to as Global Hedge 1, looks like a complicated slide, but please just bear with me for a moment. So to do this investment, assuming that you want to invest R1 million, you'll need R1 million plus 50,000 Rand. So we will assist you through Investec and currency partners to take that money offshore. If you have money offshore already, you can use that. Private Wealth will now engage with the investor to decide where they want to invest that money in various dollar-based instruments that Sanlam has got available. It's not all of them, because only certain of them qualify as collateral for the loan, which I'll explain now. But it's all safe investments to qualify as collateral. Sanlam will then give the investor a 50% LTV facility against that money offshore. So that million is now converted to $65,000, and Sanlam will give the investor 500,000 Rand against that as security in South Africa. So now you're sitting with 500,000 Rand in your hand. We then, as Futureneers, through our loan company, will then lend you the other 50%. So now you have R1 million, you make your 12-day investment. There's a 50,000 Rand cash requirement that comes in from the left-hand side here. You'll make your R1 million investment, 12-day investment, but your money is offshore and you've used geared money to make this investment, which obviously then shoots up the IRR on the overall IRR calculation because you put in less cash. Very popular. We've had great success with this model. Investors love this, and simply the reason was, investors said, we love 12J, we want to do it, we want to take advantage of the tax benefit, but we're hesitant to tie up our money in South Africa for 5 years. And we just said, well, let's build a hybrid product that we could assist investors to do both those things. So take your money offshore, put it into an investment that can grow at anything between 5 and 10% dollar-based returns per year. Plus you have the Rand hedge, remember? And then you have your 12J asset in South Africa, you get your tax benefit on it, and then you enjoy lifestyle benefits and your proceeds out of that investment.
Thank you very much, Dion. One of the questions that has arisen since you started speaking about the returns is from Liesel. She wants to know, is the guaranteed return cumulative every year or based on capital only? Do you guarantee the initial capital amount returned after the 5 years, i.e. it won't be less than what you put in? So in other words, perhaps you could just clarify the guarantee components of this investment.
So I think if I listen to the question, it's more about the exit and what is expected should you exit the investment based on the capital growth expectation. Can we just clarify if that's the case? Okay. Look, it's still property. Although you're investing through 12J, your underlying asset is still property. So it's always going to be willing buyer and willing seller in terms of the exit. So if an investor at the end of year 5 says to me, Dion, we want to exit the investment, what we have to do is to take some of those hotel rooms that the PropCo entity now owns, put them on the market, sell them at market-related values, and then distribute the proceeds. So it's not guaranteed. Obviously, it's not guaranteed because it's willing buying, willing seller. But we're confident that the sales rate in Velvet V is good enough, and if this investment produces the yields that we think it can and that it's been doing, we see no reason not being able to exit those.
Adrian, perhaps you can weigh in here as well from your experience of the long-term returns from the underlying property in this subsector of property. Perhaps you could elaborate here about how risky it actually is or not. Dion, perhaps you want to pick up on that?
Jackie, can you just repeat the question, please? You broke up.
So just a bit more detail about the kinds of returns you can expect from the underlying property asset class of hospitality properties.
Well, I think if we break it down into the two key driving elements, the one is the hotel yield, so whatever the hotel produces in terms of operational yield, and capital growth. So let's talk about hotel yield first. We reckon between 6 and 10% is achievable. Mantis would not have agreed to a 6% guarantee if they didn't feel that it or felt that it was out of kilter. If you look at the occupancy rates, prior to COVID, and what they projected now could be with phase 2 online of the hotel post COVID, I think that between 6 and 10% is achievable. And as we spoke earlier, I think the capital growth that we've estimated on 5% a year is extremely conservative. So I think we will overshoot on that by far.
Thank you. Another question here from Robert. He wants to know, can you elaborate on the profile of the current investors in this 12J?
Okay, so if we go back to that first slide of ours, we mentioned that there was 150 odd investors in Future News Capital. Now those are distributed amongst various invest or share classes linked to a bunch of different underlying assets, property just being some of them. But in this particular class of share linked to Pearl Valley Hotel, there's probably, I don't have the exact number with me now, but there's probably around 30 investors that have invested into this over the past 3 years.
And there's a couple of questions here about the minimum investment sums. Can you just elaborate on how those work and whether you can invest as a couple with this minimum sum and the maximums? Okay, so we advertise 1 million as a minimum investment. We will consider as little as 500,000 on exception. So if investors are looking to invest less than 1 million, talk to us. Yes, I mean, a couple could invest together, but important to understand that they will get separate tax benefits depending on whatever their marginal tax rate is. If you want to bump up the overall investment in terms of rand value, the couple could invest separately and then enjoy benefits together. Could be done. And it has been done. Derek has a question, and perhaps you could just add a little bit more detail here. He wants to know, what is the minimum cash investment besides the 5% option? So is the minimum cash investment 1 million rand? So does he have to hand over 1 million rand to you when he signs up?
Yeah, I think maybe just leading on to the previous question. So yeah, we advertise 1 million, but we will consider the minimum cash investment.
Okay, thank you very much. Well, we're coming to the end of our webinar, so perhaps we could briefly just summarize some of the key benefits of investing in this 12J as opposed to any of the others that are currently on offer. Dion, would you like to start with just wrapping that up?
Well, I think it's all about the underlying asset here. 12J is 12J, and yes, we have various funding options, which is unique, but the underlying asset is what it's about. It's a premium asset in probably, arguably, the best estate or residential address in South Africa. The estate has won a number of international awards, and from a property investment perspective, just on pure property investment principles, my view is that you can't go wrong to invest in this area. Adrian, maybe from your side.
Yeah, thank you. Sorry, you probably saw that we had an issue with our internet provider, so I went off for a while. So I don't know if I missed anything there. But I think I'd like to just underwrite what you just said there, Dion, is that, you know, from an investment point of view, and I'm not only just talking about the hotel, I'm talking about our investment in Pearl Valley, the Valdivia estate, One Estate, an incredible offering, which, as you've seen, is in the top 10 in the world. It's the #2 golf course in South Africa. It's the cheapest way to get an entry into probably this top estate in South Africa, certainly. So I just think that, and I want to reiterate that all your investors that come in and that we have there, we would welcome them as friends of Mantis, as partners in Mantis, and hopefully that they will enjoy all our other properties that we have on offer, mainly obviously in Africa, but we have obviously properties in other parts of the world. So I think that I really hope that it's been successful and that you are going to get the last few rooms sold. It's not as though we're trying to sell all the rooms. I think you've been very successful in so far in the rooms that you have sold. So hopefully you have a waiting list after this. And I really appreciate Jackie for putting this together, for your input, Dion, and hopefully that it's going to be very welcome by your audience, Jackie.
Thank you. Well, we've certainly had a lot of questions in today's webinar. And for anybody who would like to find out more, please do go to biznews.com. You'll see at the top of the menu, there's a special 12J section. And if you register your interest there, then we'll get all the information to you that you need. So thank you very much for joining us today. And thank you very much, Adrian and Dion, for sharing all this insightful information on this 12J opportunity. Just to clarify one thing before we go. So the deadline ends at the end of June. What do investors have to do to make sure they don't lose out on that opportunity? Dion?
Yeah, so it all depends on which funding mechanism the investors would like to use. A cash investment is very simple. The biggest complication there is probably FICA. So we can finalize a cash investment within 2 days. Once we go to the loan options, you know, there's obviously a NCR registered or NCR process that has to be followed rather. So it takes a few days just to do the loan quote, the approval of that you know, affordability. I would say probably a week. With Global Hedge One, it's slightly more complicated because the investor has to engage with Sanlam Private Wealth. So I would say give yourself at least 2 weeks to finalize that process. But from a 12J investment point of view, we're very flexible and streamlined in terms of the way that we engage investors. Everything is done electronically. We've been doing this for a long time, and you know, we're ready to take on the volumes.
And it's quite regulated as well, isn't it? You've got oversight of the independent bodies, giving that extra comfort to investors that there are some checks from independent bodies.
Absolutely. You know, this is a highly regulated sector. You know, we have to report to SARS on a regular basis. As recently as a week ago, we had to do the latest reporting to SARS. So yes, we're regulated by SARS and we're regulated by the FSCA. So yes, we have to follow strict processes and procedures and compliance.
Thank you. Well, thank you very much. And just a reminder from my colleague Dudu that there are also links in your question box if you want to find out more information from biznews.com. So thank you very much.
Thank you, Jackie. Thank you, Dion.